Hello and welcome to the new episode of Death and Taxes, a weekly podcast by the private client team at Burgess Salmon. My name is Edward Hayes and I'm a tax and trust lawyer in the private client team. And together with my tax and trust colleagues, Tim Williams and Guy Broadfield, we will be discussing a range of issues facing clients and professionals alike. In each episode, we are joined by specialist lawyers from around the firm to bring you our views on important topics for private clients. And today we're focusing on exit planning for entrepreneurs and family business owners, with a particular look at the legal and tax considerations and how individuals can best prepare for a successful exit. We're joined today by Dominic Davis and Judy Book from our corporate team. Their focus is on complex M&A transactions and joint ventures, as well as the full range of equity transactions. Dominic is a partner in that team and Judy is a senior associate, and we're pleased to have them with us.
So I think we've discussed between us before how at the moment there are a number of different companies are in different financial and commercial positions. I mean, some family-owned businesses have had a really tough time over the last 10 months and they're looking to just keep their heads above water and not necessarily looking ahead to some form of exit. In other cases where their businesses are strong and the fundamentals are good, it can be the case that those companies and the shareholders are quite a long way down the track and are looking to sell and trying to execute the deals before the end of the current tax year to give them some at least certainty, at least on the tax side. And then thirdly, there's a category of business that's done quite well over the past 10 months, is in a strong position, but not necessarily looking to sell it at the moment, but has got time and possibly some headspace to think about planning for the future. And that really is the main aim of today's pod, is to look at that third category. But before we get onto that, Dom, do you just want to say a few words about what you're seeing in the market at the moment?
Certainly. It's a very lively market at the moment. We've got a large team of corporate finance lawyers at Burgess Salmon, and it's fair to say we're being kept very busy and actually speaking to a lot of corporate finance advisors who are active in the market. They're seeing high levels of activity. So it's actually been very interesting over the last 12 months as we look back as to how activity levels have ebbed and flowed during lockdown. To start with, I think the M&A market was quite patchy. But since autumn last year, alongside some distressed M&A, unfortunately, we've seen a real return of what we class as business as usual M&A. So those companies that have traded well through lockdown and have proven very resilient, we're seeing some of those companies now come to market, and we're finding ourselves pitching for a lot of new transactions in the offing this year, as well as looking to execute those deals that we're already working on.
And those deals that you're already working on, I mean, presumably they've been in the pipeline in some cases for quite a long time. So the parties involved have had time to prepare in advance and talk to you about what's needed. So execution really is the culmination of quite a lot of hard work over a long period of time. Is that right?
Yes, I think our experience differs from deal to deal. Some deals, yes, we've been working on for a long time, and as we'll come on to, it's never too early to start preparation. And from our legal point of view, we'd like to be in there early to help the company, as we'll come on to. Others we get involved in the later stages, for example, on signing of heads of terms, and then you're straight into deal mode. But yeah, the deals that the team is looking to execute in the coming months, a lot of them started in autumn last year, but we have got a couple that have come on stream over the Christmas period, and we've got one at the moment in the tech sector, which has proven very resilient throughout, where we were instructed in December, and they're looking at a February completion timeline, which slightly but we'll see how we go.
Oh, good luck with that one. I think, Dom, you said there obviously legally we want to be involved as soon as we can. Judy, do you mind taking us kind of through what is the ideal horizon you want? Is it 12 months, 24 months, longer? Is it just sector specific? What kind of time frame are we talking about?
Yeah, sure. I think there's no set timescale, but in an ideal world, we'd want to be involved probably actually about 18 months to 2 years before the sale, which sounds like a very long amount of time. But when you factor in, there's probably some tax planning, which you would probably want to do, which Guy Ed, you're probably more familiar with than Dom and I. But if you're actually looking, well, why am I exiting? What am I trying to achieve from it? And working back, there's quite a lot of process before you're into the actual, the nitty gritty of the sale. So I think in an ideal world, you say sort of 18 months to 2 years. Often Dom and I find that that doesn't happen. We get involved later and it might be a couple of months before the sale actually starts, but that still gives you a bit of time to actually do the preparation, which Dom and I will probably come on to talk to. But I think the message we tend to try and give people is the longer the better.
Yeah, we would certainly echo that from a kind of personal tax perspective, in that some of the things that someone who's either looking for more investment into their company or looking to dispose of their stake in their family and company, for example, some of the things they can do to just support and make sure they're on firmer foundations in their own tax position, those do require quite a lot of lead-in time. And frankly, if you're given kind of a couple of months, obviously you guys in the corporate side will be able to get that job done if they need it, but there may be very limited options for the individuals to improve their personal tax position. So I think it helps everyone involved to be looking at those longer term horizons.
I think that's spot on, and I think a key point to keep in the forefront of our minds is that often the founders behind these successful businesses that are looking for investment or for sale, they have been working extremely hard over a number of years, and this sale transaction, or whether it's an investment, is a key life event both for the founder and their family if they're generating significant wealth, but also for the company. So whilst it's obviously in our interests to get involved early on, it's very much in the client's interest, because given it's a key life event, it's worth investing all the time up front, and that pays dividends literally with a successful transaction.
And Julie, would it be possible to give us a quick kind of a really high level overview of who is involved? If say we're getting involved on the legal side, who else do clients need to get on board to have either a successful exit or investment process?
Yeah, so probably sitting alongside us, the other key person we tend to see involved is a corporate finance advisor, and they sort of play the key role really from start to finish of a transaction, because we sort of see them as they're really the person who's sort of holding the client's hand through the transaction. As Dom's alluded to, this is for a seller is a really key life event for them. It's a combination of years of work, and often we find they're trying to run their business day to day while trying to do a sale, whereas for us, this is our day job. We're just trying to sell their company. So I suppose we tend to find the more successful sales are where someone's got a good corporate finance advisor who can take that strain off them day to day. And it can be sort of twofold. There's the softer side of the corporate finance side, which is effectively holding their hand, taking away the sort of the emotion of it for them, and knowing to sort of when to push the deal, or actually sometimes hold back and actually say to the seller, right, take a breath, pause, you've got deal fatigue here, we're all trying to get to an end result. Actually step back and be like, is this what I want? Or am I actually now so sort of in tunnel vision mode, I'm just push to get to the sale? So we find they're sort of useful on the soft side. And then they also have quite sort of taken their finance side of it. They tend to be key in actually packaging the company up for sale, working out, well, what are we actually selling here? It sounds pretty obvious. You might say, well, a seller's going to say, I want to sell my business, but there's many ways to do that. So they tend to actually be like, well, what's the value of the company? And they're key in actually getting you the best value for your business by packaging it right, finding the right buyer for you. And actually, when you're in the nitty gritty of the sale negotiations, making sure you protect your value. Often you come across, for example, completion accounts or earn-out mechanism, and they'll work really hard to make sure that you, as a seller, are getting all the value you can sort of eke out the business. So they're probably one of the key people we see. You'll often also see tax advisors, which can, for example, be obviously our internal team, or there might be sort of other personal tax advisors. Then sitting around the perimeter, you'll have often, if there's a due diligence process, there might be sort of other technical people who are involved that are providing some technical assistance to a seller. So I think we tend to find the team grows and grows as transactions go on, but sort of sitting at the heart of it are obviously the seller, corporate finance advisor, legal team. Dom, I don't know if you've got anything else you'd add in terms of key players.
No, I think that covers the main characters involved in a transaction. But I think from what Julie's described, you can see that there are numerous work streams that need to all dovetail and come together. And for that reason, if for example, on the tax planning side, that's a good reason why, with all of those work streams bubbling away in the weeks in the run up to completion, we need to be introducing you early on, and the team is put in place early on so that the founder or the entrepreneur knows exactly which part of his or her team is playing which role, so they can all work seamlessly together. And that's where the transactions really go smoothly, where you've got an embedded team, good working relationship, and you know exactly what each party is doing.
Yeah, and I think on the tax and trust sides, I mean, you'll confirm this, but we work quite closely with certainly private bankers and wealth managers to work with the family shareholders to work out, just how much they are going to take off the table, and put a figure on that liquidity event, and think about the future in terms of making provision for themselves and for families, and talking about all those future goals. And I think that's important just from a personal level for those shareholders, because they can see what's coming and they know that they've got the right structures in place to be able to achieve what they want. I mean, I think it's also fair to say that not many entrepreneurs or family business owners are motivated by tax relief. That's not why you set up a business, because you have corporate interests to build a business and do well through that. But I think securing a tax efficient exit and possibly making provision for family on the way are important considerations for anyone looking to sell their business. So, I mean, Ed, do you want to briefly touch on the main tax considerations, perhaps capital gains tax, that we
absolutely so
to advise on?
I think, yeah, going back to who's involved in a kind of exit or an investment, it is really important for owners and senior management to be aware that you've got to look both at the corporate tax side and the taxes that the company's going to be exposed to, but also their personal tax position. And there are things that can be done to help ensure that effectively all that hard work they've put in over the years, they get the maximum benefit from it. And we're usually looking mainly at capital gains tax on the disposal of shares, and then inheritance tax on whatever's done with that. If they're looking to pass that wealth on to other members of their family afterwards, or try and set up some longer term estate planning. And there have been quite a few changes in this area recently. So with capital gains tax in particular, you used to have entrepreneurs relief. That's now changed its name to the rather clunkier business asset disposal relief. And it's become rather less generous, because you used to get up to £10 million worth of gains could benefit from entrepreneurs relief and only be taxed at 10%, whereas now that's just $1 million. There's also something called investors relief. That tends to be less appropriate for people who've actually been setting up the business, i.e. the founders. Investors relief is more for those putting money into someone else's business. But those
and it's worth saying that for business asset disposal relief, entrepreneurs relief as we knew it under that name, there are certain conditions that need to be met for 24 months before disposal. So
well, that's it, and that's what I was going to say in terms of the planning ahead part is so important, because it's quite easy to not quite meet some of these criteria, despite having been an owner for a long time. And actually, if you give us enough warning, we can just make sure those little loose ends are tied up, and then actually when you do have your exit, you've got a nice clear tax position, because that relief is obviously applicable. Whereas it's always it's a real nightmare for someone if you come to kind of a few months out and you realize there's some technical issue with your access to that relief, because it can be valuable. It certainly was at the £10 million limit, and I think it's still valuable for people at the £1 million limit. And then in terms of inheritance tax planning, again, it's just really important for people to give thought to what form do they want their proceeds to be taking, what are they going to be doing with that in the near future, because that can make a big difference to what they're willing to accept in, for example, earn-out terms, or the form that their compensation is going to take. And so exactly as Dom and Julie have been saying, kind of it all needs to dovetail together.
And it's also important at that point to consider whether you want to make provision for other family members And particularly in the first instance, from a capital gains tax perspective, it might be worthwhile looking to transfer shares to a spouse or family member who would otherwise qualify for business asset disposal relief, on the basis that if they do meet the necessary conditions, and probably they are working in the business, then on a sale of the company, that family member can take advantage of their lifetime allowance for capital gains tax purposes, which broadly means that they would be taxed on the gains up to first £1 million at a rate of 10% rather than a rate of up to 20%. And then secondly, with a look to the longer term, if the founder or the entrepreneur in question is minded to provide for their children or possibly future generations, then it's also important to work out whether there's any planning available from an inheritance tax perspective, because broadly, I mean, shares in a trading company can, in certain circumstances, qualify for relief from inheritance tax in the form of business property relief. And that means that before sale, there might be scope to transfer some or indeed all of those shares held by the founder to a trust for the benefit of the children and grandchildren indeed, without an immediate charge to inheritance tax. And then the broad effect of putting those shares in trust before sale is then that means on sale, the cash proceeds are then paid to the trustees to hold in accordance with the terms of the trust, and then going forward, the cash is held within the trust for the benefit of the family members. And so the effect is that you've got essentially cash into a trust structure without an immediate charge to inheritance tax. Now compare that to a situation where the founder has sold the business, received the cash, and then looks to make provision for family members. Well, at that point, it's much more difficult to get cash into a trust. But broadly, an individual is limited to putting £325,000 into a trust in every 7 years. So to the extent that the founder is minded to look at options for children and wants to create a long-term vehicle to hold family wealth for future generations, then considering a trust or using a trust to hold shares before sale is certainly something they should consider.
So hopefully we've really stressed how important it is to get advisors on board as early as possible. And I suppose the key question is, well, why are you doing that? We're trying to make sure that for a buyer or someone who's looking to invest in the business, we don't have a dichotomy between what they're seeing at the outside, the big picture, and then looking under in the detail and what they're faced with. And I've said to a client before, it's a bit like if someone's buying a car. You've got a brand new shiny car, it looks fantastic on the outside, someone's really excited about the prospect of purchasing it. The last thing you want is for them to pop open the bonnet and find it's a real mess underneath, and suddenly kind of the excitement drains away, the trust drains away because they think you've been mis-selling it a bit, and that can cause real problems both for you financially and for the relationship. And so we're really keen to try and make sure everything is in order and ready to go. And perhaps Dom and Julie, you can talk us through some of the things you look at really closely in that regard.
Yeah, I think that's absolutely right. And the one of the key takeaways today I'd like to get across is that preparing your company properly ahead of exit or investment does make a fundamental difference to the ultimate sale price, and will streamline the process. And this comes from numerous deals over the years where you do see in practice that if you get your house in order and make the target company as attractive as possible to the buyer or the investor, the process will be smooth. And the key thing that you as a seller want to achieve is avoiding any nasty surprises for the buyer, because in terms of the process, heads of agreement will be agreed between the parties, and that's when they agree the value and other key deal terms. And in some ways, I've seen over time that the founders may think that that's the deal done. Actually, that's the very start of a very intensive process. Now, if unexpected issues arise during that due diligence phase, which follows the heads of terms being signed, that can really impact the deal. It can affect the relationship, as you said, Ed, between the buyer and the seller. Are things actually as we were told pre-heads? It could affect deal price. We often see due diligence issues popping up that then affect the commercial value that's been agreed between the parties, and it can, on one extreme, lead to the buyer walking away, which obviously you want to avoid, but it can impact valuation and the entrepreneur getting the clean exit. So, for example, as Julie's alluded to, we're seeing more and more actually post-COVID, a lot of earnouts where the founder unfortunately can't just walk away, but some of his or her consideration is dependent on the future performance of the business. And so nasty surprises that pop up during DD can really affect that clean exit.
Julie, can you take us through some of those? What are we looking for in terms of nasty surprises and what to avoid?
Yeah, of course. I think it's probably worth saying that a lot of these are things which actually don't affect you running your business day to day. Often we will say to ask people questions, well, can you tell us about X? Why haven't you got something? And they'll say, well, it's never been a problem before. Why do I need to sort it, for example? And that's obviously fine. If you're running your business, it works. But what the message we're trying to get across is you've got a buyer who really is sort of, using the car analogy, sort of digging into the bonnet. So a couple of the common areas we will see is contracts, for example. I think Dom and I had a deal a couple of years ago where you said, well, you've got all these suppliers, can we see copies of the contract? And the answer that came back was, we don't have written contracts. We've never needed to. We've known these people for 20 years, so it's all done on trust. That's obviously worked well, but from a buyer perspective, it's quite difficult to just take someone's word at it and say, well, if I'm about to pay a large sum of money, how do I know that this supplier is not going to turn around the next week and go, well, I was only supplying this company because I was best friends with the owner. So it's actually taking that time while you've got the time, going to the suppliers and saying, I know we wouldn't really normally need to do this, but can we put contracts in place which set out the terms? And it's much easier to do that when you've not got a buyer breathing down your neck saying, well, we need that now, otherwise we're walking away. You're keeping your commercial balance and power at that time by getting those contracts in place. That's an area we often see where it's not affected business as usual, but a buyer will want to see proper contracts in place.
Obviously, if you are putting contracts in place, you have the opportunity to make sure that there aren't any change of control provisions or things that are going to cause you difficulty. It's a great opportunity to make sure those contracts are compatible with an exit or an investment.
Yeah, exactly, because that's often an area we do see causes a bit of a problem if you've got key contracts which have change of control provisions, which mean that the supplier or the customer can actually say, well, on a change of the control of this company, I can just walk away. So often we will see buyers saying, well, I want to know that that customer or supplier isn't going to walk away. So they might make it a condition of the deal that actually you have consent from that customer, which can cause uncertainty. What if they don't give that consent, or just a delay? There's no impetus for the third party to act quickly and play ball with you, so they could hold up your deal sort of unnecessarily. So yeah, it's a good opportunity if you're putting contracts in place to make sure you don't put a change of control provision in place. I think other common areas we see are intellectual property, particularly in sort of family-owned, family-run businesses where they've developed over a number of years. You would have had the founder developing sort of key IP, for example, key products, but they've never needed to make sure the actual ownership of that IP is sitting in the company. They're running the company. Why do they need to? But if they're sort of having a clean exit, walking away, the buyer wants to know, well, actually, I'm paying value for this business, make sure the IP is sat in this business. So it can be as simple as assigning the IP across. It gets a bit more difficult if it's a family member who's not involved in the business and you're trying to track them down and get hold of them. Inevitably, it's the same point again, it adds delay. So those are some of the key areas we see. Similarly, you often find directors or key management might not have employment contracts in place on the sort of standard terms that a buyer would expect to see, particularly founders. They're involved in the business, but they might not have service contracts, for example. So those are some of the key areas we tend to see. And I think, Dom, we probably had examples of both well-run and sort of not so well-run businesses where it's had quite an impact on the sale.
I think that's absolutely spot on. And you mentioned earlier on balance of power. And I think at this stage, it's useful to highlight that as part of the heads of terms I referred to, you as a seller would be being asked to grant a period of exclusivity to the buyer in order to execute the transaction. And that's where you see the balance of power potentially shift, because the buyer knows it's now in the game, and you can't speak to any other potential bidders. So they're in the front of the race. So a good example of a well-run one last year that Julie and I were advising on, again in the tech sector, interestingly, and it ended up being sold to an overseas buyer backed by private equity, was that we got involved ahead of the heads of terms, working alongside a corporate finance advisor and the entrepreneur, and a hell of a lot of effort went into populating a really comprehensive data room and providing very detailed Q&A in terms of legal due diligence. So we had confidence when going into the transaction that we had been very upfront, given them very comprehensive information, and that enabled us actually throughout the transaction to remain on the front foot, which is very important, and it gave the buyer confidence that it was investing or buying in a really well-run entity. And so there were no surprises along the way, whereas often, and I can think of 3 or 4 on my desk at the moment, where it's not so clean, and as well as negotiating the sale with the bidder and its advisors, we're trying to undertake, to some degree or another, pre-sale reorganization to get, whether it's getting assets into the target company or actually hiving assets out of the target company to different ownership structures, and that just brings unnecessary complexity and dare I say adds to legal cost and transaction timelines, because again, what is a very intensive process for the founder who's at the center of all of these work streams. There's a lot to juggle.
So I mean, it's clear from what you said, Dom and Julia, it's a very intensive process in the lead up to execution, both for management, owners, shareholders, and advisors alike. Julie, in terms of the main takeaway points, what are the sort of the 3 things that you think people should have in mind, having listened to the pod?
Yeah, I think probably the key theme that's come across throughout this is it's all about preparation and giving the buyer confidence. So the tips that we would probably give for that is involve your advisors early, whether that's us or corporate finance advisors, and actually keep an open mind. It's quite difficult to set something in stone now, because if you're sort of looking at it 2 years out, things are going to change over time. I think Guy, Ed, you can probably come on to talk about this, as tax changes, nothing's ever set in stone. So sort of go in early, but keep an open mind. Secondly, look under your bonnet, taking the car analogy again, early, try and narrow down the list of potential issues for a buyer. And also think about, if you are key to the business, if you're wanting to exit as the founder very cleanly, do you have a good management team in place that can continue to run that business when you're gone? I think often, if a founder is very key, you need to look around and actually go, well, who's coming up behind me can continue to run this business, so that when you're going to a buyer, you're able to present, I've got an extremely strong management team here who, I'm not actually that important anymore, I'm going to step away, they'll run it, you'll keep your value in the business, buyer, even without me. So that how often we find that reduces the likelihood of needing an earn out, for example, because the buyer's confident they've got a good team that's staying in place. So I think they're probably the key tips that we would have. And I suppose the last point is sort of take a deep breath. It tends to be quite a long process, but weirdly we find a lot of people actually quite enjoy a sale process, as long as you've got the right team on board and you've got a lot of patience.
Well, we've certainly enjoyed talking it through with you. So thank you, Dom, and thank you, Julie. That's been a real pleasure. Hopefully people have found that helpful, and we hope to have you back on the pod in the future.
And it's also worth bearing in mind that we are recording this episode in February 2021, and there is a budget due to come along on the 3rd of March. So it remains to be seen what tax changes, if any, will be announced at that date, and indeed how the tax regime might change in the course of the next tax year, so from 6th April 2021 onwards. So it's important for individual business owners to keep this under review and make their decisions accordingly. Nothing can be set in stone as it stands, and it's important to keep it under consideration. Thanks again for listening to Death and Taxes, a private client podcast from Burgess Salmon. You can find out more about Burgess Salmon and our team at burgess-salmon.com or on our LinkedIn page. Our next episode will cover the issues to consider when selling strategic land for development. So don't forget to subscribe, and thanks again for listening.